Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights that'll boost your trading potential. Coming up, markets are navigating geopolitical conflict, rising oil prices, and Fed uncertainty. Liz Miller from Summit Place Financial joins us in just a couple minutes to walk through how she's thinking about the markets and portfolio positioning. Plus, Apple is pushing into lower-priced devices, trying to expand its AI ecosystem. But with competition heating up and earnings on the horizon, what are the charts saying about the next move? In today's Technical Take, we're going to break down the key levels and some option strategies for both the bull and bear cases. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. For half an hour into the trading day, let's check on the S&P 500. It did start off the session modestly lower, but it's basically just sitting about flat right now. The NASDAQ pretty much behaving the same way. Obviously, there's a cautious tone out there. Oil prices are on the rise again on the Iran conflict. Just trying to figure out where we go from here. Let's jump into the heat map and see where the push and pull is right now. If we're on the break-even line, you can see some of the tech consumer plays are higher, along with some of the pure tech names as well. Seeing some weakness, though, in healthcare and some of the industrials and some of the financials. So here's the bit of push and pull in the market. We'll see how that plays out. Want to zoom in on Broadcom here, up 5% right now at the open, and earnings and revenue beat for the quarter, issued better than expected guidance for the current period, and the CEO said the company has a line of sight to over $100 billion in revenue from its artificial intelligence offerings. And there's also a share repurchase program of up to $10 billion. You put it all together, it does have Broadcom higher in the early going. And that's your market update. Joining me now is my colleague here, Amin, from our direct investing educational team, and Liz Miller, founder and president, Summit Place Financial Advisors. Thank you both for being here. Before we dive into the conversation, just want to remind our viewers that the views and forecasts expressed are solely those of Liz and her team at Summit Place Financial, based on their research. Liz, obviously, we're still in the early stages of this conflict. The market is clearly trying to figure out where it needs to be in terms of what could come next, and we don't know what's going to come next. Well, how are you thinking about the markets in these early innings?
Thanks. It's such a difficult question. We're 5-6 days in and we still don't have a lot of visibility. How would we? So going into this, we were really looking at the economic fundamentals, where the U.S. looked pretty good. We weren't overly concerned with the labor market, particularly given such low and consistent unemployment. And we really were focused on eventual rate cuts. That view hasn't dramatically changed yet. But clearly, we're all monitoring this. And we've been saying for months now the big unknown was going to be geopolitical risk. And here we are waking up last weekend to a different world. In the markets, clearly, we see the initial reaction, that run to gold and that run to energy. But we are sticking to the longer-term view for now until we can kind of get some sense of the duration of this conflict.
Traditionally, Liz, when we see conflict in the Middle East, it is reflected first and foremost through energy prices, and we have seen some big gains on that front. At what point is the concern going to be higher oil prices flow through to the pumps for the average American? It impacts inflation, and then it gets back to the Fed.
You nailed it. That is exactly the flow, and it gets even wider than that. And we're seeing some of that immediately. We're seeing it at the pumps already. Huge move in oil. I think I was seeing high 70s this morning before we got together. Big change from where we were before this. And the first people it hits is our basic consumer. We've talked a lot in the U.S. about concerns about a K-shaped economy right now, those doing well, continuing to do well, but those struggling, seeing no reprieve. Well, higher oil prices just make it even harder on those living paycheck to paycheck. It does become a choice between essentials and filling up the car. Overall, absolutely higher energy prices go straight into inflation. If our Fed continues to be locked on target inflation and backward-looking data, they're going to hold off on doing anything with rates given higher oil prices. So more expense for the consumer, they slow their spending. higher inflation, the Fed doesn't give any relief with prices. And then you get to our corporate sector where their costs go up for shipping. They were just trying to think about how to help their margins, doing some basic cost cutting. We keep hearing about some layoffs. They're trying to handle how to maintain profitability with last year's tariffs. And you throw higher costs on their whole operation, and we're going to see stress on this economy top to bottom.
Liz, let's talk about the inflation, because you brought that up, and I think even before this conflict had even begun, there was always posturing about possibly 1 to 2 rate cuts. Maybe one was still on the cards there. So does this new uncertainty change that timeline in your view now? Is there possibly more rate cuts, or are we still holding at that 1 to 2 that we have?
The funny thing about rate cuts is when the economy is pretty stable, the Fed can afford to be very thoughtful and plodding along, right? But if this conflict continues and the cost of oil really squeezes this economy, we will eventually see major rate cuts quickly, right? If you're in a recession or you're heading towards a recession, it's the Fed's job to keep cutting rates. So I do think we could hear the tone change if the duration of this conflict keeps extending. For now and in March and the next couple of weeks, I expect the Fed to be very consistent with the rhetoric they've had, looking at the data, being backwards looking on inflation, being a little sticky. Before oil prices jumped up, we actually were seeing, some mixed messages from producer prices versus consumer prices. And we're going to hear more of that dogma. But again, if this continues, the havoc that higher oil prices can have across the economy may lead to even more rate cuts sooner in the coming months.
And Liz, May is going to be an important month because that's when Kevin Warsh comes into the picture. From my cursory readings, he seems to be more of a hawkish, Fed that's coming into the market. Not exactly what the administration is looking for. But do you think he will look through this oil inflation at any point and just continue the path that they're on with higher for longer?
I'm not that concerned that he has a reputation of hawkish. What I want to see is that the Fed broadens the way it's looking at it. Powell has been really narrow in that one, data-driven, and defining that data as looking backwards, which in my mind has always been a little bit counter to what the Fed's responsibility is. I mean, we do get the dot plot, we do get projections, but fundamentally the Fed accomplishes its job by looking forward and projecting the future. So data is an input, but I'm interested in seeing the process and the communication of that process become a bit more flexible.
Okay.
All right, Liz. Sorry, Aaron, go ahead.
Oh, no, go ahead, Greg.
I was going to say, we've outlined some risks already. Now we got a jobs report due tomorrow morning. We start thinking about risks in the markets and the job data, which has been very choppy. What is it telling us about the economy? Do we even have a clear picture about what it's telling us about the economy?
I don't know that we do have a clear picture. We were talking about the problems with the employment data right now, and there's a couple of them. First and foremost is there's a credibility problem with the data. We still will watch long-term trends, but we saw from the shutdown in the fall, we've got issues right now in Washington, that the data has been blotchy. And so there isn't the same confidence in the BLS data as we've had before. We always used to look at ADP and JOLTS as those secondary. I think now we're taking all three of them together to try to paint a picture of employment. When we look at unemployment, it has just been so remarkably stable for years. I mean, it is easy to talk about little notches up and down, but post-COVID, unemployment has been remarkably stable. So we're not really yet seeing any issues there. And then, of course, we've got the headlines of big companies talking about layoffs. That always makes everyone uncomfortable, but the actual numbers haven't yet looked dramatic to the market in terms of eventual opportunity and the health of labor.
Liz, let's talk about those big companies, because last Friday, I always want to see the market close out on a high note. And of course, we had some news drop where one of these major tech companies had announced that they were not just doing a trimming, but a haircut on their to the tune of about close to 50%. And it's always been the story of, AI paired with like workers or humans equals greater productivity. But now it's a question of AI or workers. So do you see this as being more systemic as an issue where this is kind of the path where a broader shift in how companies are going to think about hiring and productivity, and it's going to be, an either AI or, worker story?
I think it's a little early to be judging AI-driven labor changes. I think that's a real story, and I think it's a longer-term story. I think what we're mostly seeing in the headlines, and we heard about cuts across Wall Street as well. And again, I think it's not surprising post-tariffs. I think part of what's really happening is we have a lot of big companies seeing pressure on margins, passing some of those tariffs on to consumers, but having a lot of higher input costs, trying to find ways to be more efficient internally, even before AI is fully deployed. In the tech sector, it's not that surprising what we're hearing, because we know they did tons of hiring post-COVID, really building out talent and really competing with each other for talent. So hiring just to keep another company from getting that talent. And as AI drives their businesses, they need a different kind of talent. So I think what we're seeing there is layoffs that are not just for productivity, but they're probably doing a lot of hiring that's offsetting that with a different skill set. When we look across the rest of the economy, I do think we are going to see more layoffs for the sake of trying to maintain margins or at least manage profitability. And this is a good time to do it. And it's great cover to say that it's AI driven, even before some of those productivity enhancing programs are really in place. It's not surprising at this point in the economic cycle. The real question is are the headlines big enough that we're really going to see it makes a dent in the data? And I don't think we're there yet.
With this much uncertainty, we're talking about labor uncertainty, Fed policy uncertainty, geopolitical uncertainty. What are some of the big mistakes that investors tend to make with their portfolios, and how can they avoid making them?
Well, the biggest mistake, of course, with the start of this conflict is making major changes in a portfolio. When you have such uncertainty in the world, there is this tendency to quickly pull out of the markets, move a lot of money to gold. We're seeing a lot of money going into energy. That makes some sense. But in general, investors should maintain the current portfolios until we get a lot more visibility on what's happening and where it's going.
Liz, the start of this year, the talks were around that broadening of the market, the rotation. And we know with S&P 500, of course, being a market-weighted index, it is really concentrated on just a handful of tech, mega cap names, I'll say. And those have been also the growers that have really pushed the S&P 500 to these levels. So do you still see that level of concentration as a risk for investors at this stage of the game? Or is it simply just a reflection of where the growth is in the market right now? And can they muster enough strength to get us past that 7,000 mark?
Wow, there's a lot in there. I do think the concentration in the S&P 500 is a risk. We really encourage clients to balance S&P 500 exposure with either a portfolio or funds that are more equal weighted exposure. We've never in my career seen this kind of concentration in the top 10 names in the S&P, well over 30%. And I don't know anyone who builds their personal portfolio that way. We've certainly seen sector concentration in the past, and we've learned from it. You and I were talking about energy in the 80s, financials in the 90s, and how long it takes for that concentration to sort of move its way out. And it can take over a decade, and it's not because the sector collapses. It is just an evolution of the markets. So I think this concentration is durable, but I do think it brings risk. And we saw that at the beginning of the year as a lot of those top 10 names, despite the great performance last year, pulled back a lot, tanked by a lot at the beginning of this year. What's interesting is in this conflict, we would have thought investors would be moving to what we call safety sectors, right? We would have expected to see healthcare and staples doing really well. We do like those sectors for the broadening, but what we've seen all this week is that they're going back to the tech. We're seeing rebounds in all that tech, and I think, as you said, it's because the confidence, there is growth there. The question is what we paid for it, And when there's risk in the market, we're willing to pay more because we know there's growth there.
Part of that discussion of the broadening out of the markets was even the broadening out of the U.S., not only changing your sector exposure within North America, but looking overseas. But of course, with this conflict, we've seen a lot of volatility in Asian markets this week. People are worried about inflation and fuel costs, natural gas, particularly in Europe. Does that start to challenge the thinking about allocating internationally?
I think it may a bit. I've always said that, particularly in Europe, the performance last year was driven, mostly by currency. And when you look at valuations over there, things that look cheap still look cheap comparatively. And I do think Europe is most at risk with the energy costs. I think emerging markets as a whole is still a place to maintain investments this year. I do think the rate relief even that we've seen so far is useful for them and may continue. Asia, I think, is volatile partly because of the strength that it's had. We've seen that bounce up and down already this week as well. So I think their vulnerability to energy is not that distinct from opportunities elsewhere where there's also vulnerability.
And Liz, if we bring it back home, and if you think about just going back to our conversation about the mega caps, if we wanted to look beyond the mega caps, which have driven so much of this market, where are you starting to see opportunities emerge right now? I know you talked about healthcare just a moment ago, possibly the staples, but do you have any other spaces that you're looking at or interested in?
What we've really been doing is, you just nailed it. You said mega cap. We're looking in industrials. We've been looking at healthcare too. I wouldn't quite call them mid cap, but there's a lot of opportunities where there's still valuation opportunities in high quality large cap that just hasn't been as high growth and hasn't had quite the strength of a mega cap. And we've seen a lot of those coming back this year. We've seen, in a market that's been sideways, we're seeing 4% and 5% returns already in some of those areas. And as you and I discussed, some of them are like healthcare, not the pharmas, but some of the service providers, some of the diagnostic providers, those sub-industries that are well positioned but just haven't been rewarded because, as we just said, compared to the growth available in a mega tech, it didn't look as attractive. But when you're trying to balance out your full portfolio, those start looking more attractive.
Liz, before we let you go, obviously the day-to-day headlines aren't going to stop. It's hard as an investor. I have to admit, last night, instead of resting my brain and just focusing on something that had nothing to do with the world, I started doom scrolling. It's not healthy, but we do it. If we look past all of that, and I hope that I can start looking past it, what do we think about this bull market? Does it still have room to run?
I do think the bull market has room to run. You've said it. We have no idea what's going to happen with this conflict, and the duration of this conflict can change everything. But when we peel that off the top, we had an underlying economy and a market that really is actually pretty healthy. Even though that concentration at the top looks fully valued, it's a sea change in our economy that's going to go for years. And I do think it sets the stage that we have a market that can move even higher over the next few years. And I definitely think 7,000 is going to be attainable.
I'm going to put down the phone tonight when I get home and think about what you just said, Liz. Thanks so much for joining us. Always a pleasure.
Thank you.
That was Liz Miller, founder and president of Summit Place Financial Advisors. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Here, and as always, great interviews. Maybe we need to credit our producer Alicia with sending us so many fine people to talk about the markets. These are tough days, and I'm not joking. I was doom scrolling last night and put my head in a terrible set of mind frame. I didn't want to be there, but I just found myself down that hole. Obviously, there's risks there. The Asian one was interesting this week, right? And Liz basically saying, because I was trying to wrap my head around that one, but those markets, especially in Korea, had gained so much. Perhaps they were just a victim of their own success. And as you pull back the lens, you say, at least here in North America, maybe even globally, these were solid markets before we had this bit of conflict.
Yeah, absolutely, Greg. I mean, we saw with Korea as well, the Kospi, had a dramatic fall, and then I was just actually monitoring yesterday, and it's kind of risen, not quite back to where it fallen, but it was an outperformer. When you look at international market, the South Korean market has been largely driven by like the tech companies, SK Hynix and Samsung, and then Japan has also been there. So maybe it was just a little bit of profit taking off the top, or with this tension, and then participants waiting to just get back into the market. So it was good that Liz mentioned that there's still opportunities out there, especially in the emerging space. There's value still to be had there. But even domestically, I mean, we had a similar story that unfurled with S&P, with the mega caps. We saw them have significant value compression over the last, coming into this week, I should say, rather. And then we've just seen that sort of bounce that we've seen it really being rallied up now and buoyed up, maybe to get back to, I guess, what the last 2 years of their valuation has been. So there's still obviously opportunities, and which, as she mentioned, in the mega caps, but also looking beyond that in spaces like the healthcare, the consumer staples as well. And I think it was at one point the consumer staples, I don't know if it's a product of the tech mega cap companies. I think there was a stat I saw last week about if you exclude Tesla out of the Mag 7, then its valuation was just below the consumer staples for this year. So that's just a start, showing of how far they've come down and where the point of entry might be for some investors there to get back in.
Got to keep a clear head. If you at home have a question for our guests or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. You click on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace, start trading for real.
March is Fraud Prevention Month. And let me tell you, fraud is skyrocketing. In 2024, Canadians reported over $310 million in investment fraud losses. But you don't have to be a statistic. Your first line of defense is your password. Forget the basics, aim for complexity with a mix of letters, numbers, and symbol. Most importantly, never reuse passwords across accounts, especially for your investments. We recommend a fresh update every 3 months. It's a simple habit that keeps your hard-earned money where it belongs, with you.
Now, for our technical take, it is on Apple, the tech giant unveiling upgrades across its offerings, iPhones to iPads to MacBooks, even a new edition, the budget-conscious MacBook Neo. But there's a lot of competition out there, and of course, these upgrades, they want to get their Apple Intelligence, AI tools out to more consumers. Then we've got earnings landing at the end of April. That's lots to go on here. What are the charts telling us, Hiran?
Yeah, Greg, there is a lot going on, and I wish when I was a student back then that they rolled this out. I would have been much happier, and my back would have thanked me for it as well, getting those lighter laptops. But turning to the charts, you've seen Apple's story for, it's done a little for a long time, and it's, some traders are pricing in that it's due for a rollover now. And if you look at it, I've got the daily chart pulled up here. What we're looking at, Greg, is each candle represents a day. We saw from last summer, it wasn't a strong sort of, bullish channel that really propelled it, in fact, to its all-time high, which sits at this 288. This was the candle. This, in fact, we saw the rejection happen. It only had it intraday at that high price, and then obviously closed back kind of in this range. So this 280 to 285, that's the first thing I want to bring attention to our viewers. This is a key resistance wall over here. This is where you find the sellers. So anytime the stock's gone into this zone, it's had, it's swiftly fallen out of it with the selling pressure. We saw it happen again most recently in February. We came close to touching that 280 level. We saw it reject off of there, and we did see another attempt at it, but it was a lower, it wasn't even able to get to the 280 at that point. So that's one thing to keep in mind. The second thing is, once we broke out of this bullish channel coming into the end of last year and into the start of this new year, we did form a short-term trend. I like to see this, Greg. You want to see, after a strong bullish run like it did have, that the market's just taking a bit of a breather on there. Just, participants are rotating around with their profits and moving. And then we did resume sort of this upward channel. Now, what this has formed is what's called a telltale pennant pattern that I wanted to just flag to everyone. So pennant is basically, you see the sharp move up, and then you either have like a flag, which would be sort of more like a rectangular, but in this case, it's more of a triangular pattern where we're seeing these highs touching here, or you're making lower highs, but you're making lower highs, but making higher lows over here. And you get this price compression. And what we want to see is either a break to the upside for a bullish run. So it really has to break above this resistance band over here, get into the resistance zone, and then clear that. But right now, squarely, the risk is to the downside. You can see just as of today's price action, I'm going to try and zoom in as best as I can. And you can see that today's candle, we did just break below. It's not a cause for concern yet because it's fallen right into the support zone at 255 to 260. So we should see a bounce here. If it fails to hold this line, then we could see it retest and fall, break past the 150-day moving average. This is the key long-term average. Stocks pretty much stayed above it for the majority of its run so far, barring this early innings into the 2026. But we're seeing a strong buying activity happening at this zone at the 255 to 260. So that's what we're looking out for.
All right, we got the chart up. Hiren's done the work. Resistance zones, support zones. Now Hiren's going to walk us through a couple of ways we could trade Apple. Before you get started, though, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Hiren's choice. You're going to start bull or you're going to start bear?
We're going to start bear, Greg. I'm going to go with what the charts are telling me, and if I'm reading anything from it, then that's kind of where the lean is. So if we go here in the bear trade, one of the considerations you could have is if you're looking to play this. In coming up with a strategy, I first wanted to get a sense of what the volatility profile is. Remember, Apple is one of the most highly traded, options market. If you think about amongst all the stocks, it's probably in the top 3. So a lot of volume, very tight spreads, a lot of liquidity there. It is one that doesn't tend to move a lot, especially most recently. It's kind of gone sideways more than anything. Sits in the 25th percentile. Expected move, if going into sort of that April window, is about $20 from where it currently sits. So the trade we're looking at is known as a bear put spread is one consideration. This is a directional trade, Greg. So if you are expecting for the stock to come down and maybe hit those levels that we just mapped out, then this is one trade you could look at doing. The way I've looked at it is I've looked at the key levels. I've looked to buy the 260 strike put. Give ourselves a little bit more time going to the April cycle because we don't want to have time sort of take away from this trade since we're going long, and then look to sell kind of where that next level of support could be if it breaks below this 255 level, and that's sitting at about 240 where I want to sell the other side of that spread there. Now what this does is, obviously, given that the volatility profile is low, this makes the cost relatively economical. And so in this case, we're looking to spend about a $5 net debit on this trade. It's a $20 wide spread. So in this case, we need the stock to move and put our break-even price at the 255 level. So it's simply taking what I paid minus my long strike, and that gives us our break-even price there, right, Greg? So that's where we want the stock to move down to at least to start making some moolah.
All right, that's the setup. What's the risk? What's the reward?
All right. So the risk and the reward. Let's start with the reward first, of course. Directionally, we want it to go down, and I want it to get down to at least 240 by April. If it manages to do that, then I'm going to make $15 as profit. And the way to calculate that is simple. We take our spread minus what we paid for it, and that works out to $15, or in a single contract, that's $1,500. The risk, of course, whenever you do a net long trade like this, or a debit trade as I like to call it, you are going to just lose what you paid into it. In this case, it's going to be the $5 is what we stand to lose. And that's going to happen if the stock remains above 260 by the time, assuming we're holding it to expiry there.
All right, that's how a bear could possibly play it. What if someone had a bullish take?
All right. So if you're if you think there's a bit of a swing or it's going to be neutral to bullish, one of the trades you could consider doing is what's known as a credit ratio put spread. Again, nothing's really changed here in terms of the implied volatility and the expected move. And here's how the ratio piece comes in here. So what we're looking to do in this case is we're looking to collect some income. And it's kind of a bit of an overlap because I want to juxtapose the two trades. So here I've eyed the 245 level. This is kind of exactly lining up with that previous support that I had in place, Greg, where we saw a little bit of buying activity anytime it stepped into this price level right here. You can see if you extend it out, it's stepping right, we're seeing bounces off this level. So looking to sell right there, but we're selling 2 contracts at the 245. And we're going to go further down about $20 wide and buy just 1 contract of the 225. And I'll explain why the rationale is this. This is what makes up the ratio spread on this. So one of 2 things. One is if you have a bullish view on Apple and you potentially want to have an eye to own Apple, then this could be one way of doing it, because whenever you are short a put, you have assignment risk, which means you could be put that stock, and as long as it's a price that you're happy or willing to pay for, in this case 245, then you have that added benefit. But the reason I sold too is because Apple is, given the low implied volatility profile, there's not a lot of juice for the squeeze. So Greg, I squeezed some more. And that's why I did 2 contracts here. So what this ends up meaning is I'm collecting a credit of $6.25 by doing 2 contracts and just covering myself on the one with the one buy. So this means that my break-even price, no, I don't want the stock to fall, but if it does end up falling, then 238 is kind of a line in the sand, 238.75. If it falls below that, we will start losing money on that trade there. So that's kind of the setup of that trade there.
I got a feeling you got a little reveal for us too if we scroll down that chart.
Let's do this. The numbers are going to be eye-popping there for a second. So let me walk you through that. Let's start with the easy one, which is the gain. So obviously this is a neutral to bullish strategy, meaning we want the stock to come. Maybe it's going to teeter down a bit, but we don't want it to come down to 245. That's the ideal outcome. So if it stays about 245, we keep our credit square and fair at 625 in total for this setup. If it does in fact fall and it falls below this 238.75, that's where the situation gets a little bit more hairy, because in that case our max loss on this trade is going to be a whopping 25,250. Now the reason why it's so big is because we have to assume the worst in theory that Apple could go to 0, and if it does happen, then that's what we stand to lose. But the other side of this is also, remember, your losses do get a little bit enhanced because, yes, you're capped with one side of this contract, but remember, we've sold 2, so we are going to be technically uncovered on 1, which adds to that the sort of max loss picture there. So again, be mindful of this, but this is really with the view that if it does fall, I could have assignment risk as well, which means I'm going to pick up that stock, and maybe that's not a bad thing if that does end up happening. But that's kind of the downside risk to this trade.
All right, interesting possible strategies there for our audience. That is our show for this week. As always, investors should perform their own due diligence before engaging in trading. We will return on Tuesday for the bear bull debate. Jason and Hiran are going to square off on, what is it?
Rubric, Greg, and it's not like what it sounds. It's an AI tech play company. It's sort of a nascent company. I think it's in the mid to large cap, so we'll be putting that to the test. They've fared pretty well so far over the last year or so. So we'll put them under the microscope.
Not like what it sounds. I'm going to leave that to the imagination of the audience. Thanks for watching. Imagine away. We'll see you on Tuesday.